am excited today. I wanted to talk about what it looks like for seller financing and getting into a little bit of how that works, why do it, and some of the tests and models and examples that I can give you that I've done and been successful in handling seller financing. So the first up is why seller financing? For me, seller financing has given me some leverage to buy properties originally that I couldn't get the down payment for. I, at one point, bought a 6-unit building that I would never have been able to come up with the 20% for. That seller financing helped me get. There's been other properties where I just didn't want to leverage my credit and the financing option, so I did seller financing. And on the seller side, it's beneficial if you're finding a seller who owns the property outright. That is a first thing. You need to find someone who owns the property outright. So usually, and this isn't across the board, but usually they're going to be someone older who's had the property for a long period of time, and they are now looking to sell and take that cash for the retirement. So the biggest thing is making sure they're in free and clear. And the benefit for them is going to be that when they're taking all of the money from their investment property all at once, they're going to be subject to capital gains. So they're going to get hit with that tax, and they're going to see, upwards of 30-some% that is going to be removed from the income that they're about to receive and profit they're about to receive. When you're doing seller financing, the difference is if they're, say they ask for a down payment of some sort, 30,000, 40,000, 20%, whatever that number winds up being, right? It's negotiated. When they're doing that, they're only going to be hit with capital gains on that portion of the money. Everything else then turns into a loan to them. As the time goes on with the loan, it's going to the only amount of money that they're going to get hit with is the interest part of the payment for any taxable income. What that looks like when you're looking at properties and you're talking to, sometimes you might find some on the market listed with a realtor, but chances are you're not going to be able to talk to a seller face to face when you're dealing with an on-market property. So a lot of these opportunities come to you through your sphere of influence, through networking, through these meetup groups, and what that looks like. Sending out mailers, doing cold calls, finding properties that interest you and start mailing to them or getting to know that owner. There's a lot of different avenues to start connecting with people, landlord meetup groups. If you're going to a meetup for a specific intention where you're getting to know all of these people and potentially being able to buy some of their properties from them, you're building a rapport with them and you're starting to gain trust and they get to know you. That's how I was able to buy some of these properties using seller finance, because they trusted me and they knew that I would take care of the property the way they would, if not better. So finding the right property is key. Finding the right seller is key. And a lot of times that's not going to be through the MLS system. It's through ulterior motives of finding properties. So once you determine that seller financing might be an option, one of the things that I always do is look to talk to them. Maybe even if it is listed, ask the agent, is this a seller who would be interested in seller financing? I always just throw that out there. Even if I can get a loan or if I've got the money for the down payment, I'd take seller financing any day over what it would look like for having to go through the process of a loan. When a seller is looking to finance the property for you, they need to look at certain things. If they know you, they might not go through the whole hassle of the same type of credit check and all those things. If they want to go through that process, they definitely can. You need to be open with them. It'd be the same type as, getting a loan through a bank, just through a private seller. And what happens is everything becomes negotiable at that point. So what I mean by that is when you guys are discussing what interest rates are going to be, or what the interest rate is going to be, what the purchase price is. He or she might want a certain amount if it was listed on MLS that they were just getting all the cash for. But if you're offering an option for seller financing, which is a little bit riskier for them because now they're not getting all of that money up front, But if you're offering that option to them, maybe you offer them a little bit more to compensate for what it looks like to hold that note for you. Or maybe you give them an interest rate that pleases them. There's a lot of different things that you can play around with and what that looks like. So keep in mind, it opens the door to a lot more negotiation in how you structure it. And the biggest thing for me is I love a good negotiation. When you're talking to the seller, what you need to do is just figure out what is important to them. One of the situations that I had a seller in was it was an older gentleman. He wanted to take that money and he was fine with seller financing, but he was on the older side of his years, and he knew that if he were to pass away, he did not want his children to have to deal with the whole seller financing situation and wanted to get the money from me to pay them and just have it all done. So what we wound up working out is in that specific situation, he was willing to seller finance the entire loan for a 5-year period. And the stipulation in there, now he was married, so the stipulation was if he passed or if his wife passed, not together, but if one or the other passed, the loan would still be in full force. However, if both parties to this note passed, then I was responsible for, in essence, a balloon payment within 6 months of their passing. And I knew that going into that's what it would look like. But I also knew that given a year or 2 years or 3 years into it, even if that unfortunately happened, what I was doing is I was building equity in the property. It was appreciating. And now I had all the rents coming in to help cover the cost of what I might need to pay into for my down payment. Now, luckily, in this particular situation, when the time came that he did pass, his wife was still there. And I wound up actually selling the property. I was going to hold on to it, but it wound up being right next to a college, and they were running out of dorm space for that year. And so I knew it was a perfect time to sell because I had barely put any money into the property on repairs or remodel at that point. And I was able to turn it around and sell it for a much higher dollar amount to the college because they were desperate and they needed that housing. So I was actually able to terminate the seller financing before the time even came and was able to give them all of their money back before their children even needed to get involved. So there's a lot of different things that factor into it. And the big thing to keep in mind is I needed to let them know that I was looking to sell the property because that's a whole financial tax issue for them when, once again, you're now giving them that large chunk of money at your settlement. So they need to be financially prepared with their accountant on what that looks like for them and make sure that it's a good time frame for them as well. So constant communication with them and being able to, once again, understand where both parties are at, what they need, and just keep the lines of communication open for negotiation. Legal things to keep in mind. So when we are looking at a potential owner to buyer financing, a lot of times, like I had mentioned, you might not have real estate or a realtor working with you because a lot of times it could be an off-market property. Now, what I would suggest is working with an attorney to draft up an agreement, because what you're going to need is not just an agreement, a purchase contract. You'll need other things like a promissory note and any addendums and amendments that go with that. And what that is it is going to be, the promissory note is what makes sure that you are paying the mortgage back to the seller. That is the same thing that you would have if you're working with a regular lender and getting a regular loan. So you're still going to have all of those things attached to this. It is still going to be a legally binding document. It'll be done through settlement as well. You can have the attorney do the settlement. Depending on what state you're in Maryland, we can do title companies doing the settlement. But as long as all parties are in agreement, and I would definitely have an attorney review and make sure all those documents are properly prepared. One of the other things to keep in mind is what it looks like and different risks for the seller. So one of the things that the seller is going to do is no different than what a regular mortgage company does, is they're going to attach a lien to the property. So just like your bank, if you stop paying the seller, which is your lender at that time, if you stop paying the seller after a certain number of time and after a certain number of notices, depending on what is spelled out in your agreement, the seller does have the right to take that property back. So that would be the biggest risk to the sellers, have to go through the attorneys and court costs to basically repossess and foreclose the property from you. But the benefit is at least they have that asset that they get back. So while you haven't paid, they're still getting something back and they're not completely out. One of the great things about what it looks like for seller financing is being able to have the seller, if I was the seller and I was getting seller financing, once again, not having the upfront large capital gains tax that I would have to pay, but now I'm going to be making even more money on that property. So going back to him having what it would look like in order for the extra interest, that's a huge benefit, because if you've ever bought a property and they give you what the breakdown of mortgage versus interest payments look like, it's one of those numbers you don't really want to look at, right? It's a big number. So when you're doing seller financing, they're getting that amount of interest. When you're negotiating what the seller financing terms are, a lot of the times they're going to want it to be for a smaller period of time, 3 years, 5 years, maybe 10 years, but usually not more than that. Doing all of that, what it's doing is allowing them the ability to get back their money. You're doing it in a balloon payment style. So, and balloon payment means at the end of that 3, 5, 10-year period, whatever that note term is, you have to pay that lump sum back. So it's not like when you're having a mortgage payment, it's 30 years, and at the end of that 30 years, you're just done paying, right? Because it's fully paid off. A balloon payment is you haven't quite paid off that loan, because if you were to do a true loan payment for the full amount that the seller is financing over a 5 or 10-year period, your mortgage payments would be astronomical. So you don't do that. You do 5 or 10-year note, whatever that might look like for the seller. A lot of times it's 5 years, but you amortize it over 20 years or 30 years to give you the same type of mortgage payment that you would have if you had a regular bank loan. And what that looks like is the term is still the 5 years. You're adding that extra amount of time of the amortization schedule to a 20 or 30-year period, getting your mortgage payment low. And so that's why at the end of the 5 or 10-year period, you are not able to fully pay it off, because there's still a large amount of money that's still left on there. When you're ready to pay it off, or that term is coming near, once again, like I had mentioned for the one property, that you want to look to refinance it. And by refinancing it, you have already proven that rents are coming in, you're collecting money, and it should be for more than what your mortgage payment and expenses are. So the cash flow is coming in. And also what it will look like is you've got appreciation on the property. There's equity being built into the property. So it would be a lot easier at that point, because you've been a proven landlord and the property has gained appreciated, that you'll be able to get financing for it. There are a lot of commercial, and also if it's a single family, DSCR loans, and that doesn't have to go off of what your personal finances are. It goes off of what the property stands as its own. So by the lease terms, what you're making off the property, the profits, the losses, the expenses, all of those things is what is wrapped up into a DSCR loan. So if you start out with a seller financing and then are able to refinance it into a DSCR loan, then you're still not having to come out of necessarily pocket with a down payment, and you don't have to then apply the amount of money for what it looks like for your personal finances. Some of the other things to keep in mind: one of the other properties that I did seller financing for, it actually wasn't a long-term property. It's going to be more of a fix and flip. So this owner had a property, did a ton of work on it, actually took it from what was a split level house, basically knocked it down and built up a 3-story property sitting overlooking a pond he also built. But he did none of that permitted. So I knew, and it sits on 6 acres. So it was a beautiful piece of land, but I knew it was going to take a lot of money and a lot of time to either fix what he did or to get a structural engineer, architect in to do all of those things and make it right. So we worked out an agreement of what it looked like to buy the property and have him seller finance it. What we did is I knew we came up with a lower amount of money. So for the entire property in the 6 acres, we were going to work at $200,000. He originally wanted more, but he knew that there was going to be some issues since he did nothing through the county properly. So what we did is we worked in the agreement that if I was able to get all of the repairs and the structural engineer and all of those things without issue, and I was able to turn the property around quickly, that he would get an extra $50,000 as like a bonus fee when the project was done. Now, that's not going to happen anymore because we're now about 6 months into working with the county and the state and the MDE on what it all looks like to change out where the septic location is and all that stuff. And so he knew that that was going to be an issue. What I did with him is when we were 3 months into the seller note, I was supposed to have gotten refinanced out and given him his money and gotten a construction loan or a hard money loan or something like that to do the rehab. But once again, I communicated with him on what it looked like and why I hadn't been doing that yet because we still didn't have any information on at this time what the septic looked like and how we were going to do all of that. So he was able to work with me and extend our seller financing for another 3 months. And then after that 3-month period, it turned into another balloon payment where I needed to come up with the rest of the money to pay his portion back. And I was able to do that. But this property will be a great investment. It'll be a property where we can put, a few $100,000 into the actual repair and do it through hard money loans. So not my money, not his money, but a hard money lender will lend the money for that and then be able to turn it around for a profit. So there's just so many different ways that you can use seller financing. It doesn't have to be just for long term. It doesn't have to be just for a fix and flip. It can be for different things and multiple uses. There's many benefits to that. It's just a matter of knowing who to talk to, finding the right sellers, and listening to what they have to say as far as what is important to them, and then being able to structure your negotiation and the terms that you're willing to give them on what is mutually beneficial for both of you guys.